Picture this. You have been carrying a credit card for a couple of years that you no longer really use. Maybe it was your first card and you have since upgraded to something better. Maybe it has an annual fee that no longer feels justified by the benefits. Maybe you just want to simplify your wallet and reduce the number of accounts you are managing. The card is sitting there unused, and the reasonable, sensible, tidy thing to do seems obvious. Call the number on the back, tell them you want to close the account, cut the card in half, and move on with your financial life. So you make the call. The account is closed. And then 2 weeks later, you check your credit score, and it has dropped. Not by a little, by enough that you notice immediately and feel confused about what just happened. You were not trying to hurt your credit. You were trying to simplify. You were trying to be responsible. You got rid of a card you were not using. How is it possible that doing less with credit made your credit score go down? This is one of the most common and most preventable credit score mistakes that people make. And it happens because the relationship between credit card accounts and credit scores is far more complex and counterintuitive than most people realize. The card you thought was dead weight was actually quietly doing important work for your credit profile in the background. And now that it is gone, you are feeling the consequences of its absence in ways nobody warned you about. Today, we are going to break down exactly what happens to your credit score when you cancel a credit card, which accounts you should protect at all costs, when cancellation is actually the right move, and the smarter alternatives that solve the problem without the collateral damage. Whether you are thinking about closing a card right now or you already made the call and you are trying to figure out how to recover, this video has everything you need. Welcome to Clux One Finance. Let us get into it. To understand why canceling a credit card hurts your score, you need to understand exactly which parts of the FICO scoring formula are affected by account closure, and there are two major ones that create immediate and measurable damage the moment an account is closed. The first is credit utilization, and this is the impact that hits your score fastest and most dramatically. Credit utilization, as we have discussed in previous videos, is the ratio of your total credit card balances to your total available credit limit. It accounts for 30% of your FICO score, and it is one of the most sensitive and reactive elements in the entire scoring formula. Changes in utilization can move your score significantly within a single reporting cycle. Here is the math that most people never think through before closing a card. Suppose you have 3 credit cards. Card A has a $3,000 limit with a zero balance. Card B has a $4,000 limit with a $1,500 balance. Card C, the one you want to cancel, has a $5,000 limit with a zero balance. Your total available credit across all 3 cards is $12,000. Your total balance is $1,500. Your overall utilization is $1,500 divided by 12,000, which is 12.5%. That is excellent. Well within the range that supports a strong credit score. Now you cancel Card C. The $5,000 limit disappears from your available credit. Your total available credit drops from $12,000 to $7,000, but your balance stays exactly the same at $1,500. Your utilization is now $1,500 divided by 7,000, which is just over 21%. You made no new purchases. You took on no new debt. You simply closed an account. And your utilization jumped from 12.5% to 21% instantly, with a corresponding drop in your credit score that could range from 15 to 40 points depending on your overall credit profile. Now imagine you have a balance on Card C rather than a zero balance. Close an account that has a balance on it, and the utilization calculation becomes even worse because you have simultaneously reduced your available credit and maintained or increased your balance. This is why financial advisors consistently say never close a credit card that carries a balance. Pay it to zero first, then evaluate whether to keep or close it. The second major impact of cancellation is on the length of your credit history, which accounts for 15% of your FICO score. This impact is less immediate than the utilization hit, but it can be more lasting and more difficult to recover from, because unlike utilization, you cannot fix it by paying down a balance. time is the only thing that heals it. When you cancel a credit card, the account does not immediately vanish from your credit report. Closed accounts with positive payment history typically remain on your credit report for up to 10 years from the date of closure. So the immediate impact on your credit history length is often smaller than people fear. However, over time, as the closed account ages and eventually falls off your report, the impact on your average account age becomes real and significant. Your average account age is calculated by adding up the age of all your open accounts and dividing by the number of accounts. If your oldest account is a credit card you have had for 10 years and you close it, that 10-year-old account is no longer contributing to your average age calculation. The moment it eventually drops off your report, your average account age potentially drops significantly, which can produce a noticeable credit score decrease years after the original closure decision. This delayed impact is particularly insidious because by the time you experience it, you may have completely forgotten about the card you closed years earlier. The connection between the decision and the consequence is separated by such a long timeline that most people never make the link. The third impact, smaller but worth understanding, is on credit mix, which accounts for 10% of your FICO score. Lenders like to see that you can manage different types of credit responsibly. If canceling a card reduces the diversity of your credit mix, for example, if the card you canceled was your only credit card and you also hold an installment loan, reducing your profile from mixed credit types to only installment loans, there may be a small additional score impact from the reduced mix. This factor matters less than utilization and history length, but it is part of the complete picture. Now, with those mechanics understood, let us talk about the cards you should essentially never cancel under any circumstances, because there are specific accounts in most people's credit profiles that are doing disproportionately important work and whose closure would cause damage that takes years to fully recover from. The first category of cards to never cancel is your oldest account. Whatever credit card you have held the longest is the anchor of your credit history. Its age is the primary driver of your average account age calculation. It represents the beginning of your credit journey, and its presence on your report signals to lenders that you have been managing credit responsibly for a long time. Closing your oldest account, regardless of the reason, removes that anchor and immediately lowers your average account age. If the card has no annual fee, there is almost never a good reason to close it. Put a small recurring charge on it once every few months to keep it active. Pay the balance in full when it arrives, and let it continue aging in the background of your credit profile for as long as possible. The third category is any card that sits within an ecosystem you plan to continue using. If you are building a Chase Ultimate Rewards strategy and you have had the Chase Freedom Unlimited open for 4 years, closing it would not only reduce your available credit and lower your average account age, it would also remove a card that is actively earning points in your preferred rewards ecosystem and that pairs synergistically with your other Chase cards. The long-term rewards cost of losing that card may exceed the short-term benefit of simplification several times over. So when is canceling a credit card actually the right decision? Because there are legitimate situations where keeping a card open causes more harm than closing it would. The clearest case is a card with a high annual fee whose benefits you no longer use, and that cannot be downgraded to a no-fee product. If you are paying $250 per year for a premium card whose travel credits require a travel pattern you no longer follow, whose dining credits apply to restaurants you never visit, and whose reward structure no longer fits your spending, you are effectively paying $250 per year for nothing. In that case, the annual financial cost of keeping the card may genuinely exceed the credit score cost of closing it, especially if you have a strong enough credit profile that the utilization and history impacts would be manageable. Another legitimate closure scenario is a card that is actively enabling harmful financial behavior. If having a particular credit card with a high limit is contributing to spending patterns that are producing debt you cannot manage, the psychological and financial cost of keeping it open may be real and serious. In that case, the credit score impact of closure is an acceptable trade-off for the behavioral benefit of removing the tool that is causing the problem. Financial health and credit score optimization are both important, but they do not always point in the same direction. And in cases of genuine financial harm, health comes first. A third scenario where cancellation may be appropriate is a card with an annual fee on an account that is very new, less than a year old, that offered a welcome bonus, but whose ongoing value does not justify the fee, and where the account is young enough that closing it has relatively minimal impact on your average account age. If the account is 6 months old and it is not your only card or your highest limit card, the credit score damage from closing a 6-month-old account is meaningfully smaller than the damage from closing a 6-year-old account. Before you cancel any card for any reason, there are several alternatives that should be explored and exhausted before closure becomes the conclusion. The most powerful alternative is the product change, also called a downgrade. Most major credit card issuers allow you to convert a premium card with an annual fee into a no annual fee version of a card within the same product family. Chase allows you to convert a Sapphire Preferred into a Freedom Flex. American Express allows you to convert a Gold card into an Amex Everyday card. Capital One allows conversions within their card family. The product change eliminates the annual fee, preserves your credit limit, preserves your account age, preserves your credit history, and keeps the account active and contributing positively to your credit profile. It is almost always the superior alternative to cancellation for fee-justified closure decisions. The second alternative is the retention call. Before canceling any annual fee card, call the retention department and tell them you are considering closing the account because the annual fee no longer feels justified. The retention department is specifically staffed to prevent exactly this conversation from ending in cancellation, and they have tools available: statement credits, bonus points, temporary fee waivers that regular customer service representatives do not. A single retention call on a premium card has a meaningful probability of producing a retention offer worth several times the annual fee, which immediately changes the economics of the decision. You will never know what offer might be available unless you make the call, and the call costs you nothing but 10 minutes. The third alternative is simply keeping the card open with minimal usage. If a no annual fee card is sitting in your drawer unused and you are tempted to close it for simplicity, the better approach is to put one small recurring charge on it: a streaming subscription, a phone bill, a monthly utility. Set it to autopay and otherwise ignore it completely. The card stays active. The account ages. The available credit contributes to your utilization ratio. The simplicity you are seeking is largely achieved because the management required is a single automated payment that requires no ongoing attention. If you have already canceled a card and you are now dealing with the credit score consequences, here is the recovery plan. First, do not panic. The damage is real, but it is not permanent, and it is not catastrophic for most people with otherwise solid credit profiles. Second, focus immediately on reducing balances on your remaining cards to bring your utilization back down to where it was before the closure. If the utilization spike is the primary driver of your score drop, bringing utilization back below 10% on all remaining cards will recover a significant portion of the lost points within 1 to 2 billing cycles. Third, if the drop score has pushed you into a range that is affecting financial decisions you need to make in the near term, consider becoming an authorized user on a trusted person's well-managed account to add a high limit, long-standing account to your profile that improves your utilization and potentially your average account age simultaneously. Fourth, resist the temptation to open a new card immediately to replace the lost available credit. A new card application triggers a hard inquiry, the new account has 0 age, and both of those factors work against your score in the short term. Wait at least 6 months before opening new credit, longer if your score is still recovering. The credit card you close today is not just a piece of plastic or a line item in a banking app. It is a contributor to a credit profile that took years to build and that will take years to fully rebuild if damaged significantly. The decision to close it deserves at least a few minutes of careful analysis of the specific impacts on your specific profile before you pick up the phone. The alternatives to cancellation are almost always available. The product change, the retention call, the minimal usage strategy, any of these is a better outcome than the closure for the vast majority of situations where people feel tempted to cancel. Your credit score is an asset. It took time to build, and it deserves to be protected with the same intentionality you would bring to any other asset in your financial life. Treat every credit account as a component of that asset and evaluate decisions about it accordingly. Subscribe to Clux One Finance if you have not already. Hit the bell notification so you catch every video we release. Share this with someone who is thinking about canceling a card right now. And I will see you in the next one.